You know what's happening right now that nobody's talking about? Your cash is getting destroyed. Not slowly, not gradually. Right now, as you're watching this. And I'm not being dramatic. I'm talking about mathematical certainty. Because while you've got money sitting in a checking account earning maybe 0.1%, maybe nothing, the real purchasing power of that cash is evaporating at a rate that would shock you if you actually did the math. Let me show you something that'll make your stomach turn. Let's say you've got $50,000 sitting in a regular bank account. Feels safe, right? FDIC insured. Can't lose it. Except you are losing it. Every single day. Here's the reality. Even with inflation officially at around 3%, which by the way is a number so manipulated it makes Vegas odds look honest, that $50,000 loses about $1,500 of purchasing power every single year. Just sitting there, doing nothing, rotting. But here's where it gets worse. That 3% number? That's the government's version of inflation, the one they calculate after they've removed food and energy costs. You know, the two things you actually need to survive. When you factor in real-world inflation, the stuff you actually buy, groceries, gas, insurance, healthcare, you're looking at something closer to 8 to 10% in real purchasing power loss. So that $50,000, it's actually losing $4,000 to $5,000 a year in real terms. In 5 years, you've lost $25,000 of purchasing power. Half your money, gone. And you didn't spend a dime. Now, your bank loves this arrangement. They're taking your deposits, paying you essentially nothing, and lending that money out at 7, 8, 9% interest on mortgages, car loans, credit cards. They're making a fortune on the spread. Your money is working incredibly hard, just not for you. And this is where most people make their first massive mistake. They think, well, I'll just move it to a high-yield savings account. And sure, you might get 4, maybe 4.5% right now. That's better than nothing. But you're still losing ground. You're still watching your purchasing power decline, just at a slightly slower rate. It's like being on a sinking ship and someone hands you a slightly smaller bucket. You're still sinking. You're just sinking slower. So, what's the alternative? What do you actually do with cash that's sitting there, waiting to be deployed, but needs to maintain its value in the meantime? This is where it gets interesting. Because there's a reason that central banks around the world, the people who actually print money, are buying gold at the fastest pace in over 50 years. There's a reason that in the last 2 years alone, central banks added over 2,000 tons of gold to their reserves. That's not a coincidence. That's not random. That's a signal. Think about what that means for a second. The institutions that create currency are exchanging that currency for gold as fast as they possibly can. The People's Bank of China has been buying every single month for over 2 years straight. The Reserve Bank of India, the Central Bank of Turkey, the National Bank of Poland. They're all doing the same thing. Why? Because they understand something that most people don't. They understand that in a world where governments are running deficits that can never be repaid, where debt to GDP ratios are exploding, where the money supply has been expanded by trillions in just a few years, holding paper currency is a losing game. And here's the thing that nobody wants to say out loud. The system is designed this way. Inflation isn't a bug. It's a feature. It's how governments reduce the real value of their debt. It's how they transfer wealth from savers to borrowers. And the biggest borrower of all is the government itself. So, when you leave cash in the bank, you're not being conservative. You're not being safe. You're volunteering to be on the wrong side of the largest wealth transfer in human history. Let me give you a specific example. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, an ounce of gold was worth $35. Today, it's trading around $2,000. That's not because gold became more valuable. It's because the dollar became less valuable. Gold didn't go up. The dollar went down. Gold just measured the decline. And here's what's terrifying. That $35 in 1971 had the purchasing power of about $270 today when you adjust for official inflation. But gold is at $2,000. That means the dollar has lost over 98% of its value relative to gold in just over 50 years. Now you might be thinking, okay, but that's a long time frame. What about right now? What about the next year or two? Fair question. Let's talk about what's happening right now. The Federal Reserve, after raising interest rates aggressively to fight inflation, is now in a box. They've got inflation that's still running hot, but they've also got a banking system that's under stress, a commercial real estate market that's imploding, and a government that's paying over $1 trillion a year just in interest on the national debt. They can't keep rates high without breaking something, but they can't cut rates without reigniting inflation. So what do? They're stuck. And when central banks are stuck, when they're out of good options, that's when things get really interesting for hard assets. Because here's what happens next. Either they keep rates high and we get a deflationary crash, which means they'll have to print trillions to bail out the system again, or they cut rates and inflation comes roaring back. Either way, the end result is the same. More currency creation, more debasement, more reasons to hold real assets instead of paper. And this isn't theory. This is playing out right now. Look at what happened in 2008. The Fed's balance sheet was under $1 trillion. They printed their way out of the financial crisis, and by 2014, it was over $4 trillion. Then COVID hit, and they printed another $5 trillion in less than 2 years. The balance sheet peaked at nearly $9 trillion. That's 9 times more dollars competing for the same amount of goods and services. And people wonder why everything costs more. But here's where it gets personal. Here's where this affects you directly. If you're sitting on cash right now, whether it's in a checking account, a savings account, even a money market fund, you're making a bet. You're betting that the purchasing power of that cash will be maintained. You're betting that inflation will stay low. You're betting that the government will suddenly discover fiscal responsibility. How's that bet looking? Now, I want to be clear about something. I'm not saying you should have zero cash. You need liquidity. You need emergency funds. You need money you can access immediately. But there's a difference between strategic liquidity and lazy capital. There's a difference between keeping 3 to 6 months of expenses in cash and keeping hundreds of thousands of dollars earning nothing while inflation eats it alive. And this is where most people, especially people who've worked their whole lives to build up savings, make a critical error. They confuse safety with stagnation. They think that because their account balance isn't going down, they're not losing money. But they are. They're losing purchasing power. They're losing opportunity. They're losing the ability to maintain their standard of living in retirement. Let me paint you a picture. You're 60 years old. You've got $500,000 saved up. You're planning to retire in 5 years. You're being conservative, so you keep it in cash and bonds, earning maybe 4% on average. Feels responsible, right? But inflation is running at 6% real world. So every year you're losing 2% of purchasing power. In 5 years, you've lost 10%. Your $500,000 now has the purchasing power of $450,000. You just lost $50,000, and you didn't even know it. There was no market crash, no bad investment, just the silent theft of inflation. Now imagine you're retired and living on that money. You need it to last 20, 25, maybe 30 years. If inflation averages 6% over that time, your purchasing power gets cut in half every 12 years. That $500,000 becomes $250,000 in real terms by the time you're 72. By 84, it's $125,000. And you're still alive, still need to eat, still need health care, still need a place to live. This is the retirement crisis nobody's talking about. It's not that people didn't save enough. It's that the money they saved is being systematically devalued. So what's the solution? How do you actually protect purchasing power while maintaining some liquidity? This is where you need to think differently about what cash actually is. Cash isn't wealth. Cash is a claim on wealth. It's a medium of exchange. It's a temporary placeholder. But it's not a store of value. Not anymore. Not in a world where central banks are printing trillions. Real wealth is assets that maintain purchasing power over time. Real estate, productive businesses, commodities, and yes, precious metals. Now, quick aside here because this is relevant. If you're sitting on $100,000 or more in retirement accounts, there's actually a way to hold physical gold inside those accounts without triggering taxes or penalties. I put together a free guide on how gold IRAs work. It's in the description below. Covers the whole process, the rules, the logistics. Worth checking out if you're in that situation and you're concerned about protecting your retirement purchasing power. Anyway, back to the bigger picture. Because this isn't just about gold. This is about understanding what's happening to the monetary system and positioning yourself accordingly. Here's what most people don't realize. We're living through the end game of a 50-year experiment in pure fiat currency. Since 1971, every major currency in the world has been backed by nothing except the promise of the government that issues it. And for a while, that worked. The dollar was the global reserve currency. The US was the dominant economic and military power. Everyone needed dollars for trade, especially oil. But that system is breaking down. Right now. In real time. China and Russia are settling trade in yuan and rubles. Saudi Arabia is accepting yuan for oil. The BRICS nations are working on a new currency system that bypasses the dollar entirely. Central banks are repatriating their gold from New York and London. They're building their own payment systems to avoid SWIFT. This isn't conspiracy theory. This is policy. This is happening in broad daylight, and it has massive implications for anyone holding dollars. Because here's the thing about being the global reserve currency. It's an enormous privilege. It means you can print money and export your inflation to the rest of the world. It means you can run massive deficits and someone else holds the bag. But when that privilege ends, when the world doesn't need your currency anymore, all that inflation comes home. And we're starting to see the early stages of that now. The dollar's share of global reserves has been declining steadily. It's down from 70% to under 60% in just the last 2 decades. That might not sound like much, but in the world of reserve currencies, that's a massive shift. What happens when it hits 50%? What happens when it hits 40%? What happens when countries start dumping their treasury holdings because they don't need dollars anymore? The answer is inflation. Serious inflation. The kind that destroys savings and wipes out the middle class. And this is why the smart money, the people who understand how this game works, are moving out of cash and into hard assets. Not because they're speculating, not because they're trying to get rich, but because they're trying to not get poor. Let me give you another example. In 2000, you could buy a decent house in many parts of the country for $200,000. Today, that same house is $600,000 or more. Did the house get better? Did it triple in quality? No. The dollars got worse. They lost value, and if you held cash over that period, you lost 2/3 of your purchasing power in real estate terms. But if you held gold? In 2000, gold was around $280 an ounce. Today it's $2,000. You not only kept pace with housing, you beat it. You maintained your purchasing power, and then some. Now, I'm not saying gold is the only answer. I'm saying that holding depreciating currency while real assets appreciate is a guaranteed way to get left behind. And here's what's coming next that's going to accelerate all of this. We're heading into an election cycle where both parties are promising more spending, more stimulus, more programs, more debt. Nobody's talking about fiscal responsibility because fiscal responsibility doesn't win elections. Free stuff wins elections. So regardless of who wins, the deficit is going up. The debt is going up. And the only way to service that debt without defaulting is to inflate it away, which means more money printing, which means more debasement, which means your cash loses value faster. This isn't political. This is mathematical. The numbers don't lie. We're on a path that ends in one of 2 ways. Either we get massive inflation, or we get a deflationary crash followed by massive inflation. There's no third option where everything stays stable and your cash maintains its value. And the people who understand this, the people who've studied monetary history, they're not waiting around to find out which scenario plays out. They're protecting themselves now. Because here's the brutal truth. By the time it's obvious to everyone that cash is a bad place to be, it's too late. By the time your neighbors are talking about it, by the time it's on the evening news, the smart money has already moved. The prices have already adjusted. The opportunity to protect yourself at reasonable prices is gone. This is happening right now with gold. It's been in a bull market for over 2 years. It's making new all-time highs. And most people still don't own any. They're waiting for a pullback. They're waiting for confirmation. They're waiting for permission. But the central banks aren't waiting. They're buying now. The sovereign wealth funds aren't waiting. They're buying now. The billionaires and family offices aren't waiting. They're buying now. Why? Because they understand that in a world of infinite currency creation, finite assets win. In a world where governments are debasing their currencies to pay their debts, hard assets are the only real store of value. And this isn't just about gold. This is about any asset that can't be printed. Real estate in desirable locations, productive farmland, energy infrastructure, businesses that produce real goods and services. These are the things that maintain value when currencies fail. But gold has unique properties that make it especially relevant right now. It's liquid. You can sell it anywhere in the world. It's portable. You can move significant wealth in a small space. It's divisible. You can own a little or a lot. It's durable. It doesn't corrode or decay. And most importantly, it's nobody else's liability. It's not a promise. It's not a claim. It's the asset itself. When you hold cash, you're holding a liability of the banking system and the government. When you hold bonds, you're holding a promise to pay you back in depreciated currency. When you hold stocks, you're holding a claim on future earnings that may or may not materialize. But when you hold physical gold, you hold the asset. Period. No counterparty risk, no default risk, no promise that can be broken. And in a world where trust in institutions is declining, where government debt is exploding, where the banking system is fragile, that matters more than ever. Look at what happened in 2023. We had multiple bank failures: Silicon Valley Bank, Signature Bank, First Republic. These weren't small community banks. These were major institutions with billions in deposits, and they failed because they held long-term bonds that lost value when interest rates went up. The people who had deposits over the FDIC limit, they took losses. The people who had their operating capital tied up in those banks, they couldn't access their money for weeks. The people who thought their cash was safe, they learned a hard lesson. Now imagine that happening on a larger scale. Imagine a scenario where the banking system faces real stress, where multiple institutions are in trouble, where the FDIC doesn't have enough money to cover all the deposits, where the government has to step in with another massive bailout. What happens to your cash then? What happens to the value of the dollar when they print another few trillion to save the banks? This isn't fear-mongering. This is pattern recognition. This is what happens every single time a debt-based monetary system reaches its limits. It happened in Weimar Germany. It happened in Zimbabwe. It happened in Venezuela. It happened in Argentina. It's happening in Turkey right now. And yes, the United States is different. We're the global reserve currency. We have the strongest military. We have the most dynamic economy. But we also have the most debt. We also have the biggest deficits. We also have the most to lose. And when you're the reserve currency, you can get away with it longer. You can print more. You can run bigger deficits. You can kick the can further down the road. But eventually, physics catches up. Eventually, math catches up. Eventually, reality catches up. And when it does, the people who prepared, the people who moved out of cash and into real assets, they're fine. They maintain their purchasing power. They maintain their standard of living. They maintain their wealth. But the people who waited, the people who trusted the system, the people who thought their cash was safe, they get wiped out. Not because they were stupid, not because they were reckless, but because they didn't understand the game that was being played. So, here's what you need to ask yourself. What's your cash actually doing for you right now? Is it earning enough to keep pace with real inflation? Is it positioned to maintain its purchasing power over the next 5, 10, 20 years? Or is it just sitting there, slowly rotting, while you hope everything works out? Because hope is not a strategy. Hope is what people do when they don't want to face reality. And the reality is that we're in the late stages of a monetary system that's breaking down. The signs are everywhere. The central bank buying, the de-dollarization, the inflation, the debt, the deficits, the banking stress. You can ignore it. You can pretend it's not happening. You can keep your cash in the bank and hope for the best. Or you can do what the smart money is doing. You can protect yourself. You can move some of your wealth into assets that maintain purchasing power. You can position yourself for what's coming instead of being a victim of it. And look, I get it. Change is hard. Moving money around feels risky. Buying gold or other hard assets feels like you're doing something radical. But you know what's actually radical? Leaving your life savings in a depreciating currency while the people who print that currency are telling you, through their actions, that they don't trust it either. The central banks are buying gold. The billionaires are buying gold. The sovereign wealth funds are buying gold. But somehow, regular people are supposed to keep their savings in cash? That doesn't make sense. That's not conservative. That's not safe. That's just being the last one to figure out the game. So here's my challenge to you. Take a hard look at your cash position. Not your emergency fund, not your operating capital, but the money that's just sitting there. The money that's waiting to be deployed. The money that's earning nothing while inflation eats it alive. Ask yourself what that money is really doing. Ask yourself if you're comfortable watching its purchasing power decline year after year. Ask yourself if you're okay being on the wrong side of the biggest wealth transfer in history. And if the answer is no, if you're not okay with that, then do something about it. Educate yourself. Understand what's happening. Understand why the smart money is moving. And then make a decision based on reality, not hope. Because the clock is ticking. The debt is growing. The deficits are expanding. The money printing is accelerating. And your cash is rotting. Right now, as you're watching this. The question is, what are you going to do about it?